let's turn this over now to Shannon and get started. Shannon, if you click on the presentation, you should have control.
Excellent. Well, thank you, Amy. Hello, everyone. My name is Shannon Lamont, and I am the partner in charge of international tax services at iBailey. I have been in public accounting for about 20 years, and majority of that time is spent on international matters. So I want to today just I'll talk through the agenda first, noting that this presentation is geared a bit more towards the nonprofit industry. So if you are a for-profit company, of course, a lot of these items will still apply, but I'm going to have some examples related to the not-for-profit industry to make some illustrations. So first, we're going to talk about a withholding agent. What is a withholding agent? The scope of payment subject to reporting and withholding, the reporting requirements. We'll talk a bit about payments for services because there are some unique items that may be of interest to you. Also, we'll talk a bit about employees abroad, working abroad, because oftentimes that happens in the scope of the work that you're doing. And then we'll finally wrap up with some best practices. So we want to talk about who is a withholding agent, and for that purpose, it's important to understand really what's at stake. If a U.S. payer fails to comply with the withholding and reporting requirement rules, there are many implications. One, they could be responsible for the amount that they should have withheld. A late deposit penalty and interest, late withholding penalty and interest, late filing with IRS penalties, and late submission for a foreign recipient penalty. And I will say that from a practical perspective, if you should have withheld and you didn't, it's oftentimes very difficult to go back to the payee and say, I should have withheld. I'm going to withhold or withhold on maybe the next invoice that I pay, and sometimes that can cause some friction between you and your vendor. So keep that in mind as well. So who is required to withhold and report? Withholding agents are generally U.S. or foreign persons who have control, receipt, custody, or make a payment of any item of income that's subject to withholding. The withholding agent, as I mentioned, may be liable for any tax that they didn't withhold and deposit. And there are often some penalties and interest related to non-withholding. So first, we'll talk a bit about the Chapter 3 tax withholding requirements. You're likely familiar with Chapter 61, reporting and withholding. So that's where if you pay a vendor, you're required to get that W-9 documentation and then potentially send them a 1099 at the end of the year. And if you're not able to get that information, there could be backup withholding related to that. So Chapter 3 is essentially the cousin to that, and that is related to foreign payees. So if you're making a payment to a foreign person, then you are subject to Chapter 3, what we call Chapter 3 withholding, which is generally in Section 1441 of the tax code. Instead of a W-9, you have a W-8 documentation requirement, and also the reporting instead of a 1099 would be on the 1042, and there's a S, a T, and a regular 1042. So there's a number of different forms there that need to be filed. Just some general thoughts on the withholding requirements. The whole purpose of the background behind this is that foreign persons are subject to U.S. tax on their U.S. source income. So two types of U.S. source income are either FDAP, which I'll explain in the next slide, which is subject to a statutory withholding tax rate of 30%, or it's effectively connected income, and that's taxed at the regular graduated U.S. tax rate. So if you're making a payment of ECI to a company, it would be the 21%, or individual, it would be whatever their rate would be in terms of what they'd actually be taxed at eventually when they file their tax return. Generally, there could be a tax treaty that applies to the FDAP payments. The ECI, the treaty would not generally apply. And one thing to note is that the company that you're paying or the individual that you're paying, if you're paying them FDAP income, they're generally not required to file a U.S. tax return unless there's specific circumstances. With ECI, they are required to file a U.S. tax return. So that isn't necessarily going to be relevant for you, but maybe information that you would like to know as well. Okay, so the first type of income, and the one that we'll be mostly focused on, is FDAP, and that stands for Fixed Determinable Annual or Periodic Income. And this type of income is income that is not connected with a U.S. trade or business, and it's subject to withholding tax of 30%. As I mentioned, these payments are subject to reporting on the Form 1042, which we'll talk about as well. And one thing to keep in note is that the payment occurs when the foreign person realizes the income. So let's say you have accrued interest or an accrued payable to a foreign person, then generally, unless there are some exceptions that apply, that payment would be subject to withholding tax when you actually pay the cash. So what is an FDAP payment? We really have to determine three things. One, is it a payment of a certain type? Two, is the payment U.S. source? And this is something that is super important and always, well, in terms of service payments, that becomes very important. In addition to payments for royalties or use of intangible assets. And then if the payee is foreign, then we have an FDAP payment. So who is considered foreign in terms of a foreign payee? So that would be somebody that is a non-resident of the U.S., could be a foreign company. And generally, we determine this by asking them for a W-9. And what happens when you ask your vendors for a W-9 and they say, oh, well, I'm not a U.S. person. And in that case, you would pivot and say, okay, well, since you're not a U.S. person, you need to fill out the form W-8. There are two types of W-8 forms, which we'll talk about a little later. Some of the common Chapter 3 payments are interest, dividends, annuities, rents, royalties, certain gambling winnings, certain property sales, and compensation for services. If you're paying, for instance, a royalty for use of a certain piece of music, that would be one example of that. And this is really just the definition within the code, but also wanting to point out that if there is income that is payable to a non-resident alien individual that's temporarily present in the U.S. under these different immigration visas, then the 14% withholding rate applies rather than the 30%. So that would apply to, for instance, students, where the 14% if they're under the FJ, M, or Q visa, and generally the U.S. source wages are subject to federal and state income taxes. And then honorariums, so if you're paying somebody for like a one-time performance, they come to your organization to do something, then that would also be treated as service income. And we are at a polling question, Amy, and the polling question is, what does the acronym FDAP stand for? Excellent, so you all were listening. A is the correct answer. Okay, moving on to US source income. Remember, that's a second component of FDAP income. When is a payment US source? That's very important to determine. So service income is generally sourced at the place where the service is performed. So where you have employees or other agents that are physically located, where they're physically located while performing the service. So this comes up a lot when we have vendors that we're paying to perform a service in the US. It could be, let's say, an installation. It could be they're coming to give a talk. They're coming to provide some type of service, and they're doing that in the US. We do get a lot of questions about payments to foreign vendors when they are outside of the US. And the first question we always ask is, well, where will they be when they perform the service? There are times where the service could be performed both within and without the US. And so in those cases, what's required is an apportionment of how much of the income was sourced to the US. Also, we have rents and royalties. So the general rule here is that they're sourced to the place of use or place of exploitation. And the place of use is not defined in the code. So the IRS may look to where the legally protected use of the IP occurs. This could happen, for instance, if you're licensing a piece of music, or if you are licensing some software and the vendor is outside of the US, that's generally for use in the US and subject to withholding tax. We also find that sometimes equipment, so maybe you are bringing in some equipment that's being used in your work, and that would also be subject to the rents or royalties withholding tax rules. This slide just shows detail on the factors for determining sources. So we've already talked about salaries, wages, that would be considered services. That's where the service is performed. We also have inventory, the sale of inventory. And generally, if you are purchasing goods from a foreign vendor, those are not subject to withholding tax. So we won't really cover that in this presentation. Interest is sourced to the residence of the payer. And so if you're paying interest on a loan to or from a foreign vendor, that would be applicable. As I mentioned, rents, dividends likely aren't going to apply. Then sale of real property, location of property, that would be determined as to where the property is. And I'm thinking that might be the only other ones that are applicable in your cases. So this is just an example. We have a US payer that remits $100,000 to a foreign individual for independent contractor services, and all the services are being performed in the US. The payee is a resident of a foreign country, and the foreign country doesn't have a tax treaty with the US. So from your perspective, if you're making that payment, you're required to withhold 30% under Chapter 3 withholding, or $30,000. And then you would also file a Form 1042 and 1042S, which discloses the payment and the withholding. Then what happens is the person receiving the payment is going to provide that W-8 BEN to you because it's an individual. There's another form for a company, which is the W-8 BEN-E. And that would establish that they are a foreign person. And then they would be required to file a Form 1040-NR in the US. So this is really just a summary of prior to FATCA, which we'll talk about in a second. And then in addition to, there's an additional withholding under FATCA. FATCA was established a number of years ago, essentially trying to look for, the whole purpose of it was trying to find those US individuals that had bank accounts in foreign banks. And so FATCA was established to hold the foreign banks accountable to identify those people. We refer to FATCA as Chapter 4 withholding. And Chapter 4 withholding is required on FDAP payments when the payment is US source, again, similar to Chapter 3 withholding. The difference here is that it is not reduced by a treaty. For the not-for-profit industry, I have a hard time thinking of a situation where your payment would be subject to FATCA. But I wanted to raise it because you will see it coming up on the forums, for instance, and then you'll have the question of, well, what is Chapter 4 withholding? So the type of payments that are subject to Chapter 3 versus Chapter 4, the one on the right being considered FATCA, they're very, very similar. But in addition, Chapter 4 payments or FATCA payments subject to withholding tax are gross proceeds, certain insurance premiums, and some pass-through payments. Again, I'm not expecting that those would be attributable to you, but I wanted to mention it just in case. There are also many exceptions to the FATCA withholding. One of them is services. So we talked a bit about services and the 30% withholding. Also use of property, office and equipment leases. So they really are looking for those highly movable income pieces where some of these expenses are more trade or business expenses and not things like interest, dividends, and gross proceeds, for instance. You'll note that things like prizes and scholarships are not included in FATCA withholding. And that brings us to polling question 2.
All right, polling question number 2 is now open.
And that is, does your organization generally make payments to non-residents subject to withholding? It looks like about a quarter of you do. So this will hopefully be helpful for you, and maybe for those that don't, something to be aware of, and you can always come back to it if you need. All right, so now we're going to talk a bit about the documentation required. The U.S. payer always needs to keep documentation as evidence for not withholding. So one item that, well, there are a number of different ways that you can get that. One is you could get a W-9 for a U.S. payee, a W-8 for a foreign person or foreign company, and then other documentation to establish whether they're U.S. or foreign, or there's some reason why there's no withholding. One question that we get quite a lot is, well, I'm making a payment to a foreign person for services, but those services are not being performed in the US. So in general, that payment is not subject to withholding and reporting as FDAP. Because it's not a US source payment. The person didn't come, or the company didn't come to the US to perform the service. However, we do recommend, because you need to establish, have evidence that it's not subject to withholding, we do recommend that you request that the vendor put on their invoice that none of the services were performed in the US. So that way, if the IRS were to come back and audit you and see that you're making a payment to a foreign person for services, you would have that evidence on file that it wasn't done in the US. So that is just a best practice. The other best practice would be to ask them to put right in the contract that you sign with them that none of these services will be performed in the US. Okay, then the purpose of the W-8. So as I mentioned before, there are a number of different W-8s. We'll talk about about that next as well. But really what they're doing is they're certifying the foreign status of the company. So providing you that evidence in the event that you were to be audited on payments to foreign persons. Also, it's certifying that that entity or person is the beneficial owner of the income. So they're not, for instance, if you're paying it to a UK company and so it's eligible for a reduced withholding tax rate, but that UK company really isn't the beneficial owner because they're turning around and sending it to a non-treaty country, that could cause an issue. So they're certifying on this form that they're the beneficial owner of the income. Also, when applicable, it discloses the FATCA status, and also it helps to assert treaty benefits. So in a number of different treaties, you need to provide the reason why you're eligible for the treaty benefits. And this, the form will have a section which talks about that. So that's oftentimes needed, for instance, if there's a dividend payment being made, which might not be applicable in your case, but I mention it for your benefit in case you have a foreign owner, for instance. These are the different types of W-8. So we have the W-8 Ben, that's really just geared towards, it's only for individuals. We have the Ben-E, and that's geared towards entities. And so both of those would be required if, for instance, you're making FDAP payments. You are required to obtain it from the payee and keep it on file. These forms have a certain expiration date, so you will want to know what that is, generally 3 years, and refresh that form during that time period or when circumstances change. Also, we have a W-8 ECI. So that is where a company, let's say a company is doing business in the US and they say, we are going to file a US tax return. We definitely have effectively connected income. That's what that stands for. And if that is the case, they would provide you a W-8 ECI rather than a W-8 Ben or Ben-E. And that likely will go ahead, and because they will have a US tax ID, will reduce the withholding tax rate to 0. Then we have an EXP, and that's where if you're making payments to a foreign government or other organization, other foreign organization or not-for-profit, etc., that would be used. And then a W-8 IMY is really applicable when you're making a payment to a pass-through entity. So you have to look through to the ultimate owners of that pass-through entity to see if they're eligible for treaty benefits, etc. And that W-8 IMY is used for that purpose. And that brings us to polling question number 3.
All right, polling question number 3. What is a W-8 EXP form?
Excellent. You all were listening. All right, so next we're going to talk about the reporting requirements related to the payment and the withholding. First, we have the forms 1042 and 1042S. They are very similar to the 1099. So when you think about payments to US persons, you're going to report on the 1099. If the payment is to a foreign person, it's on the 1042. However, there's no de minimis filing threshold for forms such as there is for the 1099. And in addition to this, and this is something that companies often get caught off guard with, is that even if you are able to take a 0 withholding rate under a treaty, the payment still needs to be reported on this form. And also this, it is applicable to both the FDAP and the ECI payments. So in case you're wondering, well, what would the IRS look for in terms of if they were auditing your foreign payments, then what questions would they be asking? So they would look at how you determine all your foreign payees. So they might ask for a vendor download with addresses, and that's how they would discover foreign payees. They would then determine all the payments of covered items, so the FDAP payments, what type of payment for each of those you have. And then they would determine what is subject to withholding, with a presumption that the 30% withholding applies. And this is where your documentation becomes very important. So making sure that for each vendor, if you would typically get a W-9, that you have that W-8. Other allowable documentation. So one of the items that we talked about earlier was payments for services. And if you're making a payment for services, then having an invoice or a contract that states that they have not performed the service in the US. This is an example of the 1042. You will know at the top there's a Chapter 3 status code and a Chapter 4 status code. And those would be found in the instructions. They have all those codes. But the thing to note here is that not every payment would be subject to Chapter 4. So that's just something that you want to be watching out for. In this 1042 form, it's the annual form that's filed after the end of the year. I believe the due date is in February at the moment. And you would report each of the payments made during each month as shown. This one is the 1042S, so you can think of this a bit like the 1099. So at the end of the year, you would typically send your vendor the 1099 reporting the payment, and this one would be what you would send to a foreign person. Again, you have the Chapter 3 and Chapter 4 boxes on the top, items 3 and 4. It will also ask you to put in the income code. So you need to figure out what type of income it is, the gross income, and then if there is a treaty rate, you will see 3B ask for the tax rate. So if it's something other than 30%, you would add that in there as well. One thing that I do want to point out is that oftentimes there is a bit of trouble related to the tax ID number. So it's really important if you're going to be making payments to non-residents that they have some type of tax ID number, whether it be an EIN or a TIN for an individual. And if you are making payments or not reporting them without that number, it becomes very difficult for them to take a credit for the tax if a credit is allowable if they need to file a US tax return. That may be applicable, for instance, on the payment for services. So that's something to watch out for if you're making payments for services especially. The IRS just has a hard time then matching up what was withheld for what person. So it's best to get that information up front. So we talked a little bit already about payments for services, but I wanted to just reiterate because it comes up quite often. If we have payments that are sourced, they're sourced to where they're performed, and we need to make an allocation in terms of whether some of it was performed in the US and some outside of the US. We would need to apportion the income. Some of the things that the IRS would consider is travel expenses. So let's say that you say, oh no, it's all subject to, or it was all performed outside of the US, but yet you paid them, you reimbursed them for travel expenses. Well, that's going to be an indication that they may have come to the US, and then they could dig a little deeper and figure that out. So that's just one thing to look at. Again, they would look at the vendor contracts, and also they could even get the contact information and interview the vendor. Some compliance issues that are related to service payments. They're generally subject to withholding tax. Payments for financial services are generally subject to FATCA. So that could be something like payment for brokerage services, for instance. And also, as I mentioned, it's a best practice just to ask the foreign vendor to indicate whether their service is going to be performed in the US or not. Also, I wanted to talk about tax compliance for employees that are working abroad. So oftentimes not-for-profit organizations will send their employees overseas to work on a project or to establish relationships, for instance, things of that nature. And that can bring up a whole host of issues for the company. So one thing to note is that US people are generally taxed on their worldwide income. So no matter where you go in the world, as long as you are a US citizen, your income is subject to taxation. So even if, let's say, it's a small amount of compensation and you think, well, how would they ever figure that out? It would be subject to tax. When they have foreign income, and especially with addition of foreign taxes, it increases their tax return complexity. If the assignment is more long-term, then they could be eligible for the foreign earned income exclusion. So we have really two mechanisms to try to reduce the possibility of double taxation on the income. One is a foreign tax credit, and the other is the exclusion. Also, the individual may be required to file a tax return in the other jurisdiction. And we have, what we do for our clients is help them determine, what is the filing requirement in the local jurisdiction. And then if they do have a filing requirement, and it's often determined based upon the tax treaty and their local law, then we could help them secure a vendor that could assist with the tax compliance as well. I mentioned treaty benefits, so oftentimes there is sort of a de minimis in a lot of treaties. If you're in a country for less than 183 days in a calendar year or in a general year, you could be exempt from taxation in the local country. Unfortunately, in that case, sometimes there may be compliance requirements as well. So I think about, for instance, if a foreign person comes to the US and they are not subject to tax on their income because of the treaty, that provision in the treaty of 183 days, they are still required to file a US tax return to claim the treaty benefit. And so we always want to be asking that question in terms of whether there's other compliance requirements. The other thing to take note of is that social taxes are different from income taxes. They're not subject to the treaty necessarily. And so we sometimes will have situations where you are subject to social tax but not income tax. And what do we do about that? We also have instances where an employee is subject to income tax and social taxes, but they're only going to be in that foreign country for a limited period of time. If it's less than 5 years, then the US has agreements with other countries, which we call a totalization agreement. And the totalization agreement basically allows for an individual to be in a foreign country for a period of time of less than 5 years in most agreements, and not be subject to the other country's social taxes. Because at the end of the day, when that person retires, they don't want to have to go to the other country to apply for and receive benefits there as well. So this is a nice mechanism to help avoid that. The issue is that you really need to do some planning ahead of time for that, because you need to obtain a certificate of coverage to provide to the other employer. And so that's something that we can assist with if you see an employee staying in a country for a period of time that's not under the treaty withholding threshold. Also, some payroll considerations. If you are sending an employee to another jurisdiction for work for a period of time and then they're subject to withholding tax, this can be quite complicated for the company, for the organization itself. That's because just like you are required to register and withhold and pay with employment taxes in the US, that is oftentimes a requirement in the foreign jurisdiction as well. So oftentimes what happens is either the company will go ahead and register and do all, take care of all that whole process, or they might set up a foreign subsidiary just to be able to put a legal shell around that activity that's happening in the country, and to employ the person, making sure that they're following all of the employment laws there. And a third option is also to use an international PEO. So that would be a professional employer organization. You may be familiar with those in the US, but they also have organizations that help companies do this globally. And we oftentimes see that it's a bit of an expensive proposition to use them. However, if you think about the risk that they may be mitigating for you and the hassle of registering your US company in a foreign jurisdiction or setting up a new company, oftentimes if it's something that's rather temporary, it makes sense to do that. The other thing I like to point out is that if you are a not-for-profit organization in the US, that does not necessarily mean that you are not going to be subject to income tax in another jurisdiction or indirect tax, such as a VAT or a GST, for instance. And so it's important to think about whether sending that employee to the other jurisdiction is going to create a taxable presence there. And oftentimes, we hear about the situation and they've already been there for a while, and then we have to really be careful about whether they're creating that taxable presence, because obviously you're not going to be eligible for a foreign tax credit on the income that they might allocate to the country if you're not paying US tax. And so that becomes an ultimate cost to the organization. We want to be careful about that. Also, dual payroll issues come up quite often. This is a very complicated area, and so I'm going to talk just high level, that sometimes we want to pay the employee from the US, but we also need to be doing the withholding tax, etc., in the foreign location. And so what happens there is we can do a couple of different things. One is like a shadow payroll, which means you make all the payments in the US, or this could be vice versa, by the way, but you make all the payments from the US, you withhold all the taxes, and then you actually have those taxes remitted to the government in the other location in the foreign jurisdiction, as if the payment was made there. So that's something that we help companies with as well, or organizations with as well. The other thing with sending an employee to another location, if they are subject to tax, we can set up what we call an hypothetical tax calculation, where you might want to make that individual whole. If, let's say, they go to a European country, for instance, generally the individual tax rates are higher there than they are in the US, and so they might pay more tax because they're doing work outside of the US. And you might want to incentivize them into taking that assignment, so you would set up a hypothetical tax calculation to, at the end of the day, make them whole and make them a payment so that they're not paying additional tax. The other option too is that if there is another legal entity, you could enter into a secondment agreement with the other entity, whether it be related party or not, where they essentially take your employee on for a time period, and they are put on the local payroll there, and that can also have some benefits just depending on what the issues are on the foreign assignment. One thing that we have we do a lot of work on is having employees working in Canada. In my experience as an international tax service provider, I would say that most people have the perception that it should be relatively easy to do business in Canada because, hey, they're our neighbor. We have a relatively open border and it's very easy. There's lots of cities along the border where employees commute back and forth from one country to the other, and so it should be pretty straightforward. Well, I have to say it's one of the most difficult countries for us to do business in for a number of different reasons. One, well, it might be easy to do business in there, but the taxation is not easy, I will say that. One, if your entity is an LLC, there's issues with being eligible for treaty benefits. But also, if you're providing services in Canada, there are two types of withholding taxes. This slide really talks about the withholding tax on employees' wages. So let's say you have an employee and you're going to send them up to Canada to perform a training for another organization, or give let's say give a seminar or something like that. You are paying them to perform a service in Canada. And even though it's not going to create a taxable presence for you or for the employee, they have what's called the Regulation 102 withholding requirement, which says any person or company, organization that pays an individual, a non-resident individual in Canada, needs to withhold on their wages this Regulation 102 payroll withholding, and the withholding is based upon the individual tax rates there. And the issue with this is that, okay, so then the organization has to register in Canada for this payroll withholding. They have to withhold, remit the payment, and then the individual has to file a Canadian tax return to say, okay, I paid this withholding, or my employer paid this withholding on my behalf, and I am filing a Canadian tax return to get that withholding tax back because I'm not subject to tax under the treaty. So as you can see, there's, that can be very cumbersome and not fun. And there's really not a whole lot of de minimis to it. So it could be something simple, but if you're sending somebody there on a periodic basis, you have a lot of risk if you're not doing things properly. Also, in addition to the employee side of things, there is a Regulation 105 withholding, and that applies to a company. Could be a not-for-profit or a for-profit company that is performing a service in Canada. So that same individual is performing a service in Canada on your behalf. You're receiving income from it. And when the Canadian vendor when your Canadian customer makes a payment to you for that service, then they are required to withhold on that payment of 15% of the payment. So that can be a lot. Again, the company can, or the organization can then file a Canadian tax return, say, I'm not subject to tax on this income. I would like my withholding tax back, but it is a process. So just something to keep in mind if you're doing work in Canada, it can be cumbersome. Also, you should know that there are waivers that could be applied in both of those circumstances. However, those waivers have to be applied for before you enter into the transaction. So before you send the person or before you start performing the service. If you have an instance where you're performing services for a Canadian company, but not all of the services being performed there, make sure that you spell that out very clearly in the contract so that not all of the income is subject to withholding tax, and that's very important as well. I also wanted to note the totalization agreement that relates to Social Security type taxes. We do have one with Canada, so that can be helpful as well if you enter into, if you're having employees in Canada. And that brings us to our final polling question. Does your organization have employees who travel outside of the US for business?
And here are the results.
All right, it looks like 37% do. So hopefully that was helpful. Next, I just wanted to talk through some best practices. One of the things that we assist our clients with is just developing those internal processes to make sure that we're covering off on all of the compliance aspects and withholding tax aspects of payments to non-residents, so that at the end of the day, you can use more of your funds for the mission of the organization. And so we recommend that you provide training to your accounts payable or finance team. So whoever is responsible for that payment, and we've done those trainings for organizations as well. So if you don't have something or feel confident in providing that type of training, we would be happy to help you with that. We also recommend that you designate somebody in your organization who initiates document requests and follow-up requests. So oftentimes you would set up like a new vendor setup process, and making sure that in that process, if the vendor were to be a foreign person or foreign organization, that you would have a process of what documents I need and how I go about obtaining them. Also, it's important that you review the form when you get it back and make sure it's complete. Make sure that it has what you need in order to take the position for not withholding if you don't need to withhold. So again, in terms of the training, making sure that you have a designated person that can do that. And then oftentimes the IRS, when they come in to audit on payments to non-residents, they will ask for your policies and procedures. So just putting something, in writing that that goes through your step-by-step process. And it could even potentially mean that you have some, maybe your software has the capability to capture some of the vendor information. Do you need another field to indicate what form, for instance, you received, etc.? So that you can put some comments in, like, for instance, you're setting up a new vendor and the services are being performed outside the US, you might want an indicator, like right in your financial software to do that. So, and then also I noted that the W-8s, they do expire, and so it is important that if you're continuing on a relationship with a vendor, that you are making sure that you have the ability to identify when that is and to get your updated documentation. So one thing that you might do, just as a starting point, as a, just a compliance check for yourself, is to run a vendor report and just see, do you have any vendors there that are foreign? Because if you haven't been paying attention to it, you might not even know that you've had them. And if you run that report, oftentimes then you can see and say, okay, we do have an issue, we should probably spend some time on this, and go forward with that. So with that, I believe that is all I have. So I've left some time for questions in case there are any. I don't see any now, so I'll just hold on for a couple minutes in case. I thought one thing that I think might be helpful is to just see a W-8 Ben E, because they can oftentimes be a bit intimidating, but they're not really if you know what to look for. So I'll just share my screen here so that I can show you a couple of things in the W8 bin. So just a couple of things to point out here. Generally, when you send this to the organization that you're going to be making a payment to, you can tell them this doesn't go to the IRS, it's just for our benefit, so that we can identify whether we need to withhold. So they would fill out this part 1. This part top 1 through 4 is pretty straightforward. Most of the time, the payment is being made to what we call an active NFFE. That's just an active company. So let's say it's a service company, a company that provides software services, etc., things like that. That would be there. We also have a nonprofit organization, which might be applicable to you as well. So what happens is you check one of these boxes and then it tells you what part to fill out. The bottom part is also quite straightforward. Most of the time you don't need a US tax ID unless you are going to be withholding. And it's something that the withholding tax is something that they can get back, like on ECI, for instance. And in that case, I'm sorry, the ECI form would be used for that. But in any case, you would want to get the foreign tax identification number on here. And then what happens is a lot of times most of the time this isn't applicable. If there's a treaty benefit being claimed, then that's where this information goes. So they would check this and put in whatever country that they're looking to, or that they're resident in. And then if there's any special conditions to get a reduced rate under the treaty, you would put that here. And then after that, all of these sections are really just related to those types of companies that are shown up here. So you can skip through all of them. A lot of times people get this form and they say, oh my word, it's how many pages? Oh my word, how do I do this? And so a lot of times it's just going here, clicking on the active NFE. That means that less than 50% of their gross income was passive and less than 50% of their assets were passive, and they're not a financial institution. And then they go ahead and sign that here. So it's pretty straightforward if you have some familiarity with it. It can be intimidating for vendors, especially small companies. So I always am happy to walk somebody through it if needed as well. So, all right. Let's see, any difficulties or tips on getting a foreign government to fill out the W8 Ben EXP? I have not had any difficulties, but perhaps somebody else has. Yeah, that's a good question. Sorry, I don't have the experience with having issues with it. So with that, I think we're all set, Amy. And if that person wants to go ahead and message me, I think on that last slide, I had my contact information, but my information is also on our website, and I'm happy to help out as needed.
All right. Well, thank you all so much for attending, and thank you to Shannon, and we hope that everyone has a great day.